This is Perspectives, a bi-weekly investment podcast brought to you by Escala Partners. In a world cluttered with information, Perspectives cuts through the noise to bring you insights and commentary on global financial markets, economics, and geopolitical news and events.
Welcome to Escala Investment Perspectives. And of course, welcome to the new financial year. We've covered a lot in the podcast over the last 12 months. And while there has been plenty going on in financial markets, today we'll again focus on some of the big thematics shaping the future. And of course, to provide the insights is our Chief Investment Officer, Tracey McNaughton. Welcome, Tracey.
Hi, Ed.
Now, Tracey, last week we spoke about what you called the sovereignty trade. We discussed how countries are rebuilding strategic capability and why governments are placing greater emphasis on resilience rather than efficiency. And this week, I'd like to continue that conversation, but from a completely different angle. Everyone seems to agree we need more defence spending, more energy security, more semiconductor manufacturing, and more artificial intelligence infrastructure. But what no one seems to be talking about is the bill. Can governments actually afford another nation-building cycle?
Well, I think the short answer is not on their own, Ed. And I think that's one of the biggest shifts investors and indeed us taxpayers need to understand. Historically, governments were the primary funders, the financiers of nation building. If a country wanted to build highways, electricity networks, or space programs, governments generally had the fiscal capacity to do it. Today, the ambition is just as great. It's perhaps greater, actually, but the fiscal space is more limited. Countries need more of the traditional nation-building stuff, defence, energy and transport, but now they need the infrastructure to support artificial intelligence. And as Sam Altman, CEO and co-founder of OpenAI, says, this is not even a technological shift that happens every generation. This is one of the big ones. We are experiencing the biggest, most expensive nation-building program in history. This at a time when the government coffers are very low on cash. Many developed economies entered this decade carrying debt levels seen outside of wartime. And then the pandemic hit, which quite rightly required governments to provide enormous fiscal support. And now, just as interest rates have normalised and the cost of servicing that debt has increased, we're asking governments to fund this massive nation-building program. One of the more revealing moments during the recent Senate scrutiny in Australia of the tax reforms that came out in the budget, it was when Treasury Secretary Jenny Wilkinson said basically, we needed the money. Her response was refreshingly direct. Governments ultimately need revenue right now. So we are in an awkward position. This infrastructure requires capital. It requires lots and lots of capital. And the question is whether sovereign balance sheets can support it.
Tracey, does that mean bond markets become a much bigger part of this story?
I think they have to. For most of our investing careers, Ed, we've almost taken government borrowing for granted. There was an assumption that governments could simply issue more debt whenever they needed to. I'm not sure that's a safe assumption anymore. It's certainly not in the UK, given what they are going through. And just as a side note, interestingly, the governments that have the biggest debt burdens, Japan, UK, Italy, France, have also had the biggest turnover of prime ministers. So the point you could possibly make there is as fiscal flexibility declines, political flexibility often declines with it. So it makes it harder to do the nation-building stuff. I think markets may begin demanding greater compensation for providing capital to governments. That's really what a sovereign risk premium is. It's the return investors require in order to lend money to governments. I don't think we're talking about developed countries defaulting on their debt, far from it. But I do think we're entering a world where investors become more discriminating. Countries with strong fiscal positions may continue to borrow relatively cheaply. Countries with weaker balance sheets may find the cost of capital steadily rising. So in other words, sovereign risk may once again become something investors need to think about rather than simply assume it away as we did previously, Ed.
Tracy, the price of sovereignty isn't just building the new infrastructure or the cost of it, it's also the cost of financing it.
Yeah, exactly. And I think that's the conversation that markets are only just beginning to have. Bill Clinton, former US president, famously said early in his presidency to his cabinet, "So what you're telling me is my success or failure as president depends on what the bond market does." And they basically said, yeah, the bond market is your banker if you're the government. And so you need to be nice to your banker. Already the bond market is providing debt finance to Amazon at a lower interest rate than it is to the US government on a 10-year basis. The bond market is becoming more discerning. And so governments will have to make choices. They can't fund everything. And if governments can't fund everything themselves, well, the obvious question becomes, who does?
Tracy, let's discuss that. If governments are entering this new nation-building cycle with weaker balance sheets and less fiscal flexibility than they've had in the past, then somebody else has to fund it. And so who are the alternatives? You may have just given us a hint in your last answer.
Yeah, when you step back, there really aren't that many options. Governments can borrow more, funding it by taxing more. And we've seen what that does to the tenure of political leaders in Europe. So that's not a hugely popular option. Or they can rely on the private sector, who in some cases, as with Amazon, can fund it more cheaply. So I think, though, each option comes with its own trade-offs.
Before we get to private sector capital, let's talk about taxation, because it feels like we're already starting to see that debate emerge. The headlines over the past week have been dominated by President Trump's threat to impose tariffs on countries introducing digital services taxes on American tech companies. So on the surface, it looks like another trade dispute. But do you think it's actually something much bigger?
I do. I think it's a good example of the conversation we've been having here. The UK and many countries across Europe are looking at the digital economy and asking a relatively simple question. The largest digital platforms generate, and this is Microsoft, etc., generate enormous economic value within their borders. Yet much of the profit ultimately accrues elsewhere, as in the US. So from their perspective, Europe and the UK, if governments need to invest more in the infrastructure to support artificial intelligence, so energy infrastructure, data centres, critical minerals, etc., shouldn't some of the beneficiaries of the digital economy contribute more towards funding it? The United States naturally sees that very differently. It argues these taxes disproportionately target successful American companies and ultimately reduce the returns to innovation. But what's interesting is I think both sides are really debating the same issue. They're debating who captures the economic value created in a digital economy, and ultimately who uses that value to finance sovereignty. I suspect we'll see more versions of this debate over the coming decade, not just in technology, but across energy, critical minerals, and strategically important industries.
Tracy, if governments are constrained and taxation becomes politically difficult, that inevitably pushes more of the burden onto private sector capital.
Yeah, that's right. Governments will still determine what capabilities matter. They will still establish industrial policy. They will still decide where strategic investment should occur. But increasingly, they will rely, I think, on private sector capital to fund it. And I think that's a fairly profound shift. We've moved from governments being the owner-builder, if you like, behind nation building, to, in a way, becoming the tenant. And once you recognize that and understand that, a lot of what we're seeing in markets begins to make much more sense, I think.
And so why is that such an important distinction for investors?
Well, I think because it changes who captures the returns, whether it's electricity transmission, data centers, communication networks, satellite infrastructure, or advanced manufacturing. Private investors increasingly provide the balance sheet. That creates extraordinary investment opportunities, as we're seeing with the returns. but it also creates important policy questions. Governments need to ensure the benefits of these investments remain broadly shared across society. This was easier to do when the government was the owner-operator and the spoils would accrue to the government, which could then be redistributed to ensure a sense of equality and fairness. But now, much of the new nation building is owned by the private sector.
Tracey, we're already starting to see governments actively encourage private companies to become partners in rebuilding strategic capability. South Korea is probably the best example this week. The government has plans to build what it describes as super gap advantages in industries like semiconductors, AI data centres and physical AI. And companies such as Samsung and SK Hynix are expected to commit enormous amounts of capital alongside the government.
I think it's one of the clearest examples we've seen yet. If you look at what South Korea is trying to achieve, it's not simply an industrial policy, it's a sovereignty strategy. The government has identified a handful of industries that it believes will determine the country's future prosperity, competitiveness, and security. Semiconductors, artificial intelligence, robotics, and the infrastructure that supports them are no longer viewed simply as commercial opportunities. They're being treated as strategic capabilities, nation building. What's particularly interesting is how the government intends to achieve those ambitions. It isn't proposing to nationalise these industries or build everything itself. Instead, it's creating the policy framework, investing in enabling infrastructure and working alongside companies like Samsung and SK, who are expected to provide much of the capital, the technology and the execution.
So that sounds like a very powerful partnership, but it also feels like it creates another challenge. How do governments ensure the benefits are shared broadly across society rather than simply accruing to a handful of companies or shareholders?
Well, that's right. We touched on this a little earlier with the digital services tax Europe is proposing. Building strategic capability is only part of the issue. Maintaining public confidence is just as important. South Korea is already beginning to grapple with that issue alongside the excitement about becoming a global leader in semiconductors and AI. There are questions being asked about whether the benefits of that investment will be broadly shared across society. But it's not just about sharing the benefits, it's also about sharing the costs, as was the case with the digital services and Europe. If you take data centers, though, as another example, we all want the productivity gains that artificial intelligence promises. But increasingly, communities are questioning whether they want large data centers built in their own neighbourhoods because of the demands they place on electricity, water, and local infrastructure, not to mention how they look. So society benefits from the capability they create, but the costs are often concentrated in particular communities. So I think governments need to consider carefully who pays, who benefits, and who bears the cost. If those three groups are the same, projects tend to have strong public support. But if they're very different, opposition tends to grow. And so if you look at the Snowy Mountains scheme, that was taxpayers who paid that. The whole country benefited through electricity and irrigation, and the costs were relatively broadly shared. Compare that with a modern data centre. Investors provide the capital, the hyperscaler and shareholders earn much of the return, and AI users around the world benefit. But the local community may experience higher electricity demand, increased water use, more truck movements and visual impacts. So those groups are much less aligned. So I think success in this new era of nation building isn't just about raising capital. It will be about aligning interests. I think we're in the early days of getting that alignment.
Tracy, that brings us back to Australia. We already have one of the world's largest pools of long-term capital through our superannuation system. Maybe one way of getting that alignment is by having each of us invest in it via our superannuation fund. Think this debate eventually arrives here?
I think it probably almost certainly will, if it's not already happening. Australia's superannuation system now manages $4.5 trillion on behalf of Australians. If governments are looking for patient, long-term capital to fund nation-building assets, well, it's only natural that they will look towards superannuation. And, I think in many respects, those projects are well suited to long-term investors. Infrastructure often generates stable, inflation-linked cash flows over many decades, which can align very well with long-term retirement savings. But there is an important distinction we need to preserve. Governments naturally look at superannuation and they see a source of capital. Trustees, superannuation trustees, look at exactly the same money and see something very different. They see the retirement savings of millions of Australians. Their responsibility isn't to deliver government policy. Their responsibility is to maximise long-term risk-adjusted returns for their members. Now, sometimes those objectives align perfectly, but sometimes they won't. The role of government is to create investment opportunities that are attractive enough for private capital to participate voluntarily. The role of trustees is to decide whether those opportunities genuinely serve the long-term interests of members. Maintaining that distinction, I think, is fundamental to the integrity of our superannuation system.
Perhaps the sovereignty trade isn't really about defence, artificial intelligence, or semiconductors at all. It's about trust. Trust that governments will make the right long-term decisions. Trust that private capital will help build the infrastructure society needs. And trust that the benefits and the costs of that investment will be shared fairly. Because ultimately, that's what gives nation building its social licence. That's all we have time for today. Thanks for joining us for another episode of Perspectives. Hope you enjoyed the podcast today. And of course, we look forward to you joining us for the next episode. Until then, please take care and stay safe. Thank you.
Thank you for listening to Escala Perspectives podcast. Be sure to subscribe to this podcast on iTunes. You can connect with Tracey by visiting escalapartners.com.au. Escala Partners is a corporate authorised representative of Escala Wealth Management, which holds its own AFSL. This podcast has been prepared without consideration of specific client investment objectives, financial situation, or needs, and is for general information purposes only. Please don't rely on it for the purpose of making an investment decision. You should seek independent financial and taxation advice prior to making any investment decisions in relation to any of the content considered in the podcast, and consider any relevant disclosure documents. If you require any further information regarding the matters discussed on the podcast, please contact Escala Partners.